I will
Ladies
ping
and
you.
gentlemen, welcome to the SoFi Weekly Podcast. Let's go through some numbers, ladies and gentlemen.
I am very excited about the tech platform. The next 2 or 3 years is going to be very interesting. They had a win from a regional bank. They're in the RFP stages with multiple large financial institutions. And this is what can get SoFi to have a tech valuation and not a financial institution valuation if they start grabbing market share and if their platform is utilized for cloud banking in the regionals and in the large money centers. We saw everything fire on all cylinders. We saw a lot of growth in deposits. Member growth probably surprised all of us. I mean, it was really good. Beat on revenue, less of a loss, increased guidance again. Morgan Stanley finally stopped being bearish, they're neutral. This was the first quarter since Q1 2021 where every one of the segments increased quarter over quarter. Everything led to a contribution profit this quarter.
That was huge.
Like this entire year was them building in the background to set themselves up for a prime time year where they're gap profitable on 4 quarters, growing on all their business segments, and ultimately have the market action reflect that. The goodwill impairment charge was literally the only negative that I could find, and it's an accounting quip. It's like it's a paper loss. It's not even a real thing that's going to affect them. Go from negative 29 cents EPS to positive GAAP EPS in 1 quarter. Like from the purposes of profitability, it's not a real thing. Well, if it wasn't for the goodwill impairment, like this is a 10 out of 10 quarter, but the goodwill impairment, in my opinion, is the only thing that bears are going to hinge on. All the numbers were great. Like they alleviated concerns around selling of the loans. They alleviated concerns around that student loan origination coming back, financial services being sustainably profitable going forward. The efficiencies in spend where they lowered expenses on Galileo side and they raised margins and contribution profit and the revenue. Tech platform looked perfect to me. Exactly what management said they were going into the end of the year, raising guidance for the third time in 3 quarters in a row. I just couldn't find anything else to nitpick, let alone to criticize.
The tech platform contribution margins, before they were holding in just a little under 20%, now 19.0%. This quarter, it jumped all the way up to 36%.
The one thing I'll say with that, it is incredible, and it's basically a perfect quarter. I mean, goodwill impairment, whatever. With the tech platform, one thing that I've seen a couple of people note, and I agree, is they need to invest a lot of money up front. And so now that we're actually seeing those roll off, they're still investing, of course, but that's why it's bumped up so much. So it's still phenomenal. It's not growing like the numbers may indicate. So
yeah, but this was still a ramp up quarter. Like management basically said at the beginning of the year, we lost current. We are moving from on-prem to cloud. We're making some changes. They had a couple of cuts on the tech platform side of things. They cut, I think, a couple hundred people, I think it is. Basically redundancies as they merged in Technisys with Galileo, like normal cuts. And they said, hey, look, we're going to go through this trough and it's going to accelerate towards the end of the year, right? And so the natural sort of logical conclusion you can come to is it's going to be better in Q3, best in Q4. That is the trend that I'm following and that I've been following for the last couple of quarters. The expenditures, like optimizing CapEx, is not isolated to just the tech platform, right? Like,
oh yeah.
To add 170,000 more members for only $4 million more in sales and marketing spend is insane.
Yeah, but they didn't say that's going to be the new speed of members.
No.
They said it will go probably down to 500,000 again. But
3 things to say on that. Number 1 is they said that the member count to look out for is over 500,000. Like, don't set your baseline at 6 or 7.
Not back to 4.
Exactly. And then number 2, they said that depreciation, amortization, and stock-based compensation would all be going up towards Q4. So those are sort of a couple of things to keep in mind as we go into next quarter.
They are doing everything in their power to ramp for 2024, especially as a lending company, that this quarter is a blow-off quarter, okay? Do all your write-offs right now. They don't even need to do that yet. They want to get a lot of the large member growths, okay, this quarter, spend a lot on sales and marketing, write off your impairments, do everything like that for the next 4 quarters where they should be, net income positive every quarter from there on, okay? They said contribution profitable on all 3 quarters for the foreseeable future, from here and beyond. I think that they had to write that off so then they can have just a much stronger place to be in 2024, especially. And it's also a tax write-off for them. So it's not the best. I wish we didn't acquire Technisys at more than what we needed to. But the problem happened whenever we bought Technisys. It didn't happen in Q3. We acknowledged the problem in Q3, but the problem happened all the way back then. So there wasn't anything we could do about it.
Technisys was an all stock deal. They diluted us. I'm good with it. They didn't spend a single penny on it, all stock. And it's for a strategic piece in a long term vision that complements Galileo and separates them on the tech side. So I don't want to burst anybody's bubble, but I'm going to give this quarter an 8-1.
I honestly agree with you. Although the tech platform contribution margin, the improvement definitely made me happy on the tech platform side. I do think there wasn't any real large institution that I know of that actually joined.
The bear case got slaughtered because what has been the revolving bear case? Oh, student loans aren't coming back, and then they come back. This isn't happening, and then it happens. Well, guess what? 105.1% selling loans, doing a securitization with BlackRock for ongoing streaming funding source. I mean, what else? The only thing the Bears can say at this point is they're not profitable. That's the only thing they can say, and that's coming this quarter. 90% of SoFi's deposits are from direct deposits. So that's a very sticky environment. And when you look at the end of 2022 through the past 9 months, SoFi has seen a 113% increase in their deposits.
Mhm.
And 3 out of the 4 large money centers have seen a negative decline. JP Morgan's the only one that has seen an increase, highlighted by the blue. And then when I look at quarter over quarter, I mean, SoFi grew their deposits by 23%. And 2 of the large money centers were in the negative, 2 were in the positive. I mean,
I'm going to assume from US Bancorp side that they probably acquired one of these banks that had died off.
I think they did acquire a book of business from somebody. I don't remember who though.
They must have.
SoFi is growing, and these legacy banks are just not as interesting to the younger generation. And that's the generation we want because that's the generation that's going to have the largest earnings power over the next 10 years. And we're playing the long game right now. So I'm not really that worried about their bank or deposits or gaining members. They're going to keep coming.
They put people's fears at ease with regards to student loan originations and the whole moratorium situation that was going on there. Those are the types of things that I want to hear on an earnings call because they help reduce the uncertainty that any skeptic or bear, dare I say, might have on SoFi going into 2024.
Yeah, and look, their margins are increasing. You went from a Q2 revised to 17% adjusted EBITDA to 19% for the end of the year on the high side of the guidance and the low side.
Phenomenal. Like the best quarter I think they've had. I think we'd all agree on that.
Yeah, I would say it's their best quarter ever. The problem is that whenever you're a lender and you're dealing in originations, you're stuck to the macro. That's the only problem. Like that's why I think analysts didn't revise their price targets up at all, because the problem whenever you're dealing with a company with a very heavy balance sheet as a percentage of their total company versus asset light businesses is that it doesn't matter if you're JP Morgan or your little old SoFi. If 70% of your business relies on this one style of lending, still at risk of a large recession. And that's why I believe the price targets have not changed at all. Right.
Dare I say that we're not getting a recession in 24 unless something really bad happens?
Sure. That's fine. That's fine. But there is a percentage that do believe we will. And that's the
A lot
percentage
of people
against
believe it, but what they seem to not understand is the data is the data. The data doesn't lie. Recessions typically happen except for 1963, I believe, with 5% unemployment. We're nowhere near it.
Originations are amazing, but it doesn't mean that necessarily other companies can't originate a ton of unsecured personal loans. They might be a little bit worried about the consumer, potentially people defaulting and not paying back those loans. We're kind of digging ourselves a future grave. If rates stay higher for longer, the consumer falters and SoFi's left holding that bag.
I mean, look, every single bank, it doesn't matter how large or small, has risk whenever somebody has to borrow money. But they're writing to a different FICO, they're writing to a different salary level, different income level, And I do a fair amount of research on the Fed. I was actually looking at the CME group tonight. There could be a cut as early as March. Last week, it was as early as May.
Yep.
I think a pivot's going to come maybe sooner than later. I said May, June, maybe March, April.
Like I was saying this to Tanner earlier today, like you cannot underestimate the power of it being an election year. Nobody wants a crappy market on an election year.
Incredible what they keep doing. Certainly others can replicate that, but yeah, the quality of the loans speaks for itself. And SoFi, I think that they're adopting the right strategy. You know, looking back when they first started the rate hikes, I'd be like, oh yeah, by this time 2023 for sure we start cutting. Is like it keeps getting moved, so
Right.
we'll see.
0% chance in January is what CME Group has shown. 0% chance in January. But you get to March, you got 25.5% chance that we get a 25 bip cut. That was not there last week.
Yeah.
And then you get into May, it starts dropping down. This is much higher than it was last week. And May, June is a big time where we could start seeing the pivot. And looking out to 2024 December, these three handles were not there. You got an 11.9% chance. They were not there last week. We are at the end of the tightening cycle.
They sold a personal loan book at 105%. And they said that was at a higher coupon rate than what they have on average.
Yeah, exactly. And we sold home loans at a weighted average execution level of 100.2.
I think what people are saying is, okay, how can we slow down on our loan originations if we're getting committed capital at $2 billion and an additional securitization at $375 million? We're doing like $5 to $6 billion of new originations every quarter. I'm not saying that like, I honestly think that we can continue to originate at that amount and hold it if rates actually do start to come down in March or even later. I probably would assume actually June or something like that. I'm sure we could hold out for multiple quarters. But if it gets extended again, that's when the bear case comes in. And if people don't think that it gets extended again, I mean, it got extended previously.
Look, I agree with his thesis. I'm still a shareholder of Palantir. I didn't sell, but he had a big gain. You never get hurt taking a profit. I mean, I don't think people should have went after you the way that they did because it's your money, not theirs.
All right, let me make it super clear. I am very bullish on Palantir in the long term. And I get this, that there's a cohort of people that are saying like, oh, well, if you sold, you're really not that bullish. I get it. Okay. I traded it. It was 1% of my portfolio that I doubled up on at $8. But when did Palantir blow up? When they announced that sustainable profitability. I still think SoFi has that moment ahead of them, and we're just setting up for that moment. And every subsequent quarter that passes, the confidence in that moment increases that will actually happen. And that's the powder keg that's going to blow up. And so for Palantir, I felt that, okay, that moment has happened. And yes, AI is very exciting. And yes, AIP can lead to some very exciting stuff. I really love to see the revenue rate that was increasing from 13% to 16%, and we're thinking that it's going to go back up higher. But look, I think that a lot of the catalysts for Palantir were priced in a really shitty macro environment for fintech. It's going down as a blanket, right? Some of them are just being hurt when they're not supposed to. And Palantir was a company that I was just like, oh, wait, I'm sorry. I thought we were supposed to be in a bad macro environment. This thing has doubled up on me. Okay, well, let me reallocate that into something that I know way more. It doesn't necessarily mean that I'm bearish on Palantir and bullish on SoFi. What's funny is I've sold positions and had immediate regret and FOMO. I can genuinely say I didn't have that with Palantir. And I even posted, I was like, I wish all the best for bulls and congratulations on the 20 or 25% gain, because I can sleep easier at night knowing that I reallocated into a position that I just know way more about. Like, I don't really know a lot about Palantir, and my position sizing reflected that. I do think that prime time moment going into 2024 is still ahead for SoFi. And that's all I'm trying to capture.
It is important, though, that whenever it's hard to just get a 1% gain, that Tevis would lose sleep over 1% of his portfolio holding something like Palantir that maybe he doesn't believe in. So
I invested a whole bunch of stuff in growth in 2020, and people can like go back and look at the videos. I've made way more mistakes than I've made like the right calls. Absolutely. I'll be the first to say that. And there's a bunch of bags in my portfolio that are 1% positions that started as 4% positions or 5% positions that just went to shit. And I don't really feel confident in adding back to them. I have been adding back to some positions like Pinterest, heavily in Tesla, heavily in SoFi, added back to Palantir earlier this year. And so like some stuff that I believe in that I still think are intact, but then there's a bunch of other stuff that I'm not holding. Like the idea is to concentrate into stuff that I actually know and not have the context switching trying to manage 25 positions.
Palantir, I think is maybe slightly overvalued. I don't think it's as much as you may feel, and part of that just you have a less understanding of Palantir, and like Palantir is not easy to understand. It's not. So like nobody should be like throwing shade because you took a profit. Because I mean, why not? You know, if Palantir runs up to like $30 for me, I'll be like, man, I hadn't planned to sell any shares, but SoFi is like still at 8, so I don't know. I'd have to think about it. And if AIP is monetized in 20 or over this next year, which I think that it will be, yeah, they're gonna win. Like just beat SoFi. Like I would be shocked if SoFi. It's possible that the sentiment changes and everything, and I'm wrong, but it's not going to be the blowout like everybody is like, or some people are portraying. So it's
So
I think
SoFi
it's gonna be close.
has the potential for a big moment next
does.
year. And I
And I
don't
think it's
think
happening.
it's January or February when they report. I think it's May. I think they need to show that profitability is not a fluke. And I think they need 2 or 3 quarters of net income to prove everybody that's not a fluke and things to go right for a little bit. And then I think it's off to the races because at that point, there's nothing the Bears can say. And I think at that point, you start seeing maybe some institutional buying. Man, upgrades would be nice because this is, if we can get some stuff on the tech side going, this is going to be something special. I really believe that.
If all goes well this time next year, we're going to be talking about SoFi S&P 500 inclusion and when that might be coming because they would be eligible, right? It would be 4 quarters of profitability. This time next year is essentially what Palantir just experienced 2 days ago and what Palantir shareholders are, hyped about, essentially that 4 quarters of profitability. So
Does SoFi have a path over the next 4 quarters for
No.
S&P 500 inclusion?
4 quarters, no, because they're not got profitable right now.
Well,
Well, I mean from Q4 on.
So there's a possibility like it's over the last 4 quarters. So the negative, if there's strong enough positive that over 4 quarters, including this present one, but then it still takes usually 3 to 6 months for
6
inclusion.
months,
If
yeah.
they're serious about including you, they can roll it out for much longer than that. And some companies are. So my guess is that it's maybe a 1% chance that SoFi would possibly be included in the next year in the S&P 500. It's very unlikely it can happen.
There is a market cap requirement. I guess the thing that I'm talking about, I actually believe there's 4 quarters of gap profitability. I'm not stating that. I guess what I am asking is, do you believe that there will be capital appreciation over the next 4 or 5 quarters?
I think management is strongly incentivized for there to be. Yeah, their PSUs kick in when? I think February 2025, something like that.
People need to talk about that more often. That's the price targets for SoFi for Noto to hit his targets is $25, $35, and $45.
So Tannor, to be included in the S&P, you need a market cap of 14.5 billion right now. The value of its market cap traded annually, at least 250,000 of its shares traded in each of the previous 6 months. Most of its shares in the public's hands, had its IPO at least 1 year earlier, have a positive sum of the previous 4 quarters of earnings, as well as the most recent quarter. So they could theoretically have
So what is the biggest?
One blowout quarter and the latest one and be eligible if they're profitable.
$14.5 billion market cap, and I'm sure that actually goes up over the next year. So let's just say 15 billion. Yeah, so that would mean about a $15 price target for SoFi.
I mean, if you ask Steve, that's going to be in December. So we could definitely.
If the markets rally, SoFi can rally.
Yeah, seriously, look what happened just in the past week, right? November 1st hit.
But think about it. You got another Fed meeting coming first week of December.
SoFi's short interest increased, actually.
I don't understand shorting SoFi, especially here. Like if it shot up to 15, maybe
the short is that it goes bankrupt.
That's dumb. There's plenty of vulnerable companies, especially in this macro. Why not focus on those? I don't understand. Like, it makes no sense.
No, this is not what I think. I think that this is what Wall Street is thinking, is that their loans will end up getting priced at below fair value because net charge-off rates are going up because the consumer is constrained. If interest rates, let's say, can go up 25 more basis points, then that means our existing book would not be as exciting as new loans that could be signed. So there's no reason to buy old loans. At that point, we can't originate anymore because we don't want to sell the loans. And so the loan book that we are holding is defaulting at a higher percent than people think. And then our growth goes down to near zero because we can only grow as fast as people are paying off their loans.
I could make a pretty good bear case for SoFi. You have a lot of doomsday people who really do believe we're going into a heavy recession, that people are going to default on debt, people are going to default on mortgages, people are going to default on car loans, banks are going to be holding the bags on assets, loan companies are going to be holding the bags on loans. People really do believe this. Now, once again, if employment does not go to 5%, I don't see that happening. And we're nowhere near 5% right now.
Even that, I mean, I understand SoFi hasn't gone through a recession, but I mean, they pivoted through COVID when they shut down. I just don't see this management team going belly up and just, getting destroyed as a company. Like, it's going to hurt everybody if a recession hits, but
they're
they'll
writing to a
survive.
different tier of people with financial power. I mean, that's the biggest thing. And quite honestly, if the tier that they're writing to goes through a recession, this country is going to be in a depression. Because think about what that means for everybody else.
Customer acquisition costs drastically fell. But the real question is, once again, I'm going to have to bring this up. Do you guys think that that's going to happen again this quarter? Because I'm going to strongly say it goes back up.
Two perspectives, right? You can say, well, it's going to go back up because the member count is not going to be as high. But you can also say it's not going to go back up because the sales and marketing is going to get cut like no tomorrow.
Maybe, but it just, I don't know if that's happened.
It feels to me like we picked up 200,000 Swifties for free. And I don't know that that's sustainable, but God bless Taylor Swift.
She needs to do a concert every year there. And I hope she does tours every year because she creates an economy everywhere she goes.
Sales and marketing since Q3 of 2020. Sorry, I just made this chart, so it's not nice, but I don't think it's going down.
Like, sales and marketing is a lever that they can control. It's not something like it's not like, G&A, like, oh, we'll need to fire people to like lower that. It's like, just do less spending on sales and marketing promotions.
Another thing too, what I've been seeing recently, people talking about the Galileo thing, that really we can't give SoFi any real multiple because of Galileo, because they're only growing in single digits. They did expect that we'll be growing in like the teens in Q4. So they are expecting a first sort of transfer of clients in the fourth quarter. And the reason why, by the way, just so everyone understands, that whenever it comes to these big clients, not only do you have to win in these RFPs, like what Steven has said, these take a very long time and are very complicated. And I would love for you to speak on this, Steve, because it is very important. But then not only once you onboard a client, then it takes a very long time for them to even want to take their traditional book of business and transfer it over to a new card program. They might start out with only new clients that come on, just trailing it to get used to the system and everything along these lines. Then they might bring over their traditional clients. That's when you see the big boost in members, right? So it will be some time. It's probably because we've already onboarded a new client and that we already know the book is supposed to come over in Q4. So that's why they're expecting a large jump. It's probably because of a large client.
I would speculate that the scale and the scrutinization that SoFi is going under is immense, because you're talking about banking. You're talking about a ton of regulations. You're not talking about a SaaS company. You're not talking about hiring a consulting company to overhaul something. I mean, this is serious regulations. So I would speculate that the RFP process is probably 6 to 12 months. And just because you win an RFP does not mean you generate revenue the next day. Now, there could be an implementation cost. To get to that point, who knows how long it could be, but it could take some time. Now, the good thing is that when SoFi eventually does start winning some of these, and I'm saying that very hopefully, it could create a buzz. You don't know, as Noto has said, they go in the door for one aspect and then they don't know that they have Galileo or Technesis, vice versa. Maybe they come out with a different piece of business than they originally went in for. People start talking and they get invited to more RFPs. This is something, and I've been saying, 2 to 5 years that this is going to take to pay off. But if it does, it's going to be immense.
One thing I want to add on to that is, like, they take a long time, but remember, there's a premium you have to add on to the time it takes just because they're legacy institutions that are behemoths to move. So it's going to take a little bit longer, but at the same time, the switching costs are insane. So once they settle on Galileo, then they're good to go.
They're
Tannor,
only doing it one time.
exactly.
They're not doing it now and then doing it again in 3 years. This isn't something they're bidding out every 3 or 5 years.
Once one of these big legacy institutions moves, they have regulatory pressures for the entire industry to move, and there's word of mouth that starts to spread when they figure out the optimizations from a cost savings perspective they can have on Galileo.
I wanted to mention, because there was a little bit of talk online with the great Amit and uh, Christopher Hager talking about, is SoFi just a bank, and is the multiple on that company actually worth it, right? They were talking about comparing Palantir to SoFi, because actually the revenue is very close, and earnings might actually be very close as well. I know one's GAAP and one's not profitable, but or sorry, one's net income positive and one's not, but they're actually quite close. But the multiple on the stocks are extremely different. Amit and a couple other people said SoFi is just a bank, it's boring, yada yada yada. And now I do think that a Palantir, to a point, should hold up a much higher multiple, because it's AI and these sorts of things, and they're doing great, and there's so much room to have massive S curves. But I do think it's dumb to say that SoFi is just a bank, because it doesn't matter, right? It's about growth rates. It doesn't matter what industry
I'm
you're in.
about to fucking put my hand through the goddamn screen because this is so dumb. It's dumb because it shouldn't matter. And this is the problem I have with so many investors. Shouldn't matter if you're a SaaS company or making fucking widgets. If you are generating revenue and you are generating net income or whatever it is, profitability and revenue, you can compare any two companies. And if you have two companies that are doing two completely different things, and one company is growing at a quicker pace and making more money, it should be valued more than the other company.
I agree.
Enough with the shenanigans about one makes Coke and another makes a SaaS product. It's ridiculous. It is ridiculous.
And so that's honestly what I just wanted to talk about, is I think that the same thing could be applied to just regular commerce, talking about Walmart and how boring of a company that is, and how Amazon is boring because they're just trying to digitize commerce. And
Guys,
and that
Apple
same idea
sold
of
off
what?
because Apple sold off today and did not participate in the rally because their revenue year over year went down by 2.1%. Guess what? Their EPS grew by a penny. Their freaking net income was 96 or 97 billion dollars. Their free cash flow was 99 billion dollars. It's the most profitable company in the freaking world. They give back 80 to 90 billion dollars a year of cash through dividends and buybacks. Like, to think that this company sells off because one year they don't freaking generate excess revenue. You look at profitability. Businesses are in the business of generating profits. A company that generates revenue but never makes money is worthless. Doesn't matter.
So let me sort of step in the middle ground here. Obviously not to go super on one side of the spectrum or bash any side. I think that a lot of critics will say that SoFi is a lending company because the majority of their revenue comes from their lending segment. But if you look at members, the majority of their members are in the financial services segment. You could just as easily say SoFi is a brokerage because they have a ton of members on the invest side. And SoFi is a tech platform because of the prospects of Galileo being a unifying infrastructure platform as a backend to all the financial institutions out there in the next decade, right? So it depends on the lens by which you look at it as well. Are you looking through pure revenue? Are you looking through company prospects and tailwinds? Or are you looking through members? Like, depending on how you look at it, you can come to different conclusions. And I think the through line there is that it's a diverse company. It can't just be called a bank because of those different lenses by which you can view it.
I think Amazon was once just a company that was digitizing commerce with a small tech platform, right? I think that the total addressable market that they were in, and small amount of market capitalization that they had, allowed them to completely take over because they had a better product. They had a better mousetrap. And That's
The
exactly what
market
SoFi is doing.
aside,
And the tech platform has massive, massive scale that they could achieve.
both Palantir and SoFi have massive potential. And that is measured in revenue and net income and EBITDA and free cash flow. And right now, one is doing better than the other. We don't know what's going to happen in the future, but it's a ridiculous conversation because you got to go by the numbers.
But love you guys, appreciate you, and bye for now.
See y'all on the member side.